Hello, everyone. Welcome to another edition of your Daily Five. My name is Chris Kimble, founder of Kimble Charting Solutions, and today is May 19th. Today, I wanted to go through and talk about what I want to just say is 5 financial warning signs you can't afford to ignore in the markets. One would be a valuation model from John Hussman and Associates. I want to share with you the Russell value versus the Russell growth ratio, a couple of charts on semiconductors and what I think are some really important levels that they're testing in a couple of different charts, and emerging markets, why I think they're at a really important inflection point. So this is a chart from Hussman Advisors, and so if you've not heard of John Hussman, his firm, I'd suggest that you give him a look. It's hussmanfunds.com. And I started following them in the early 2000s. And the thing that intrigued me was right in here in 2000, I was fortunate that my mentor and friend, Sir John Templeton, said, Chris, here's 10 reasons why I think the market will be flat for maybe at least 10 to 15 years to come. And it was hard to believe at that time. But John, it was one of the very few, that was my 20th year in the business at that time. And he was the only mutual fund manager that I knew that had the okay from a prospectus perspective to head to cash. He didn't have to be long only, but he could also short, and he made a lot of money in the 2000 to 2003 decline. And so we all know that there are many ways to value this market, and I don't want to say this is the holy grail of valuation models, but John's as a doctorate in economics, a very bright man, and so this always catches my attention when John publishes a chart like this. And so this is the Hussman margin adjusted PE ratio that goes clear back into the 1920s. And just the bottom line is you see in the 1940s when it was really undervalued, and I was fortunate to get into the business in 1980. And this is when John Templeton was on Wall Street Week and the Dow was at 777. And he said, I don't think we'll ever see these prices again. Well, you could see why. But this is where he said right here that he thought the market would struggle for 10 to 15 years from a buy and hold basis. And I humbly never thought we'd see valuations above the dot-com era, but now you can see that valuations are above 1929 and 2000. So these are great this is a great awareness tool, but it's not a timing tool. And so I'm not telling you anything new. A lot of people talk about things being excessive. But so today I want to share with you 5 charts that I want you to be aware of that could really send an important signal with valuations where they are. And so this first one is the Russell. As you know, the Russell company looks at much more than 500 stocks, and they can look at a few thousand stocks. So this is the Russell growth versus the Russell value index, and it's IWF and IWD. And so you can see here was the 2000 peak, and it actually blew through it over this past year, representing that growth in tech was doing much better. But this one catches my attention right now, that as all of you know that are technically oriented, that old resistance can become new support. So the trend is still up. It's testing old resistance, which is now 21-year support here at 1. So this is a key level. But to me, the most important level would be is if it would break this support line, again, with valuations where they are, that would send a signal that you probably should know where the exit door is for some of your long positions. So another one that has my attention a lot is the Semiconductor Index. And so this is on a monthly basis going back clear into the early 1990s. But if you take the 1996 low and the dot-com high, you can see, and apply Fibonacci to it, you can see that the Semiconductor Index had potentially double topped right below its 261 extension level and at the top of this 13-year rising channel. So the trend is still up. There's not a bearish message coming from semiconductors, but if they would break this shelf of support at 2, it would be another sign you're going to want to know where the exit door is for your long stock positions. So this is the Semiconductor Index, which again, I love semiconductors because they're the guts of the computers. And I know most of you are aware that there's a lot of newly built cars that can't be delivered or sold to people because of a chip shortage from the semiconductor industry. So semiconductors are, this is my 41st year in the business, maybe more important now than ever. But this is a semiconductor QQQ ratio, and you can see in 2000 this was support. Right before the financial crisis, this was support, and again, old support can become new resistance. So the trend since 2012 is up after a double bottom, and this is a monthly chart. But you'll notice now for what, 1, 2, 3, for 4 months, the majority of this year, it's banging its head at resistance here, which used to be the old support. And so if we would see a breakdown here at 2, again, this would be a signal to know where the exit door is with your long positions. Another ratio chart that it's fascinating how this works out, but this is the Nasdaq Composite, and I think the Nasdaq Composite is more important than the Nasdaq 100, as this is a couple of thousand shares, or excuse me, a couple of thousand stocks, compared with the Nasdaq 100 just being 100 stocks. And so you can see that this ratio has reflected after this large decline after the dot-com highs. This double bottom was made in essentially 2002. So for what, 19 years, almost 20 years, this index has made, or this ratio, excuse me, has made higher low after higher low after higher low. And it's just reflected that tech has been a better place to be than the S&P. Despite the S&P doing well, this reflects much more relative strength by tech stocks. But here's what's crazy, in my opinion, that on a monthly basis, what happened earlier this year? It came back and tested the 2000 highs right here. And so there's a chance this is a double top 20 years later. And so again, here's a shelf of support. Is this possibly a head and shoulders top? Only time's going to tell. But again, the bottom line is, if support would break at 1, you're going to want to know where the exit door is for your long positions in stocks. We've all witnessed a lot of, I don't know if any of you have talked with any of your friends or coworkers or somebody in your apartment or condo complex about lumber prices, what they've done. But unless you live under a rock, you're probably aware that lumber's went up a ton, and so have commodities. And one of the areas that can benefit a lot from commodities is emerging markets around the world, because a lot of them are commodity rich countries. And so this is a look at EEM. And so EEM, emerging markets, is testing, in my opinion, a really critical level, which was the 2002 highs here. After topping around $55 a share, you can see that it spent several months in the $20 range. So that was well over a 50% decline. And so now, as it's worked its way higher, making some higher lows, it's now spent, similar to some of the ratios that we looked at earlier in this slideshow, 4 to 5 months testing the 2007 highs. And this is a monthly chart. You'll see that right in here, this is one of the largest bearish monthly reversals in the last 14 years. So if this shelf of support would break, it would suggest that you know where the exit door is with your long positions. So to me, one of the most important charts comes from StockCharts that you can, if you're a member, or I advise you, suggest for you to become a member, is the advanced decline line. So there's been obviously a lot of talk, Nasdaq has been soft, some internal stuff's been going on, but as I said before, if I could just be on a desert island and have one chart, this would be the chart to see. And so if the prior, the trend is still up, but if the AD line would break support at 1, no different than the prior charts, I'd sure want to know, where the exit door, is. And right now, that has not happened. But if the AD line would give in and break the support line, it would suggest to really be aware that we've all probably played musical chairs in our lives. You'd want to know, what are you going to do if the music stops? And lastly, there's a huge test for commodities right here. And so this is a counter trend rally in a bear market. So what happens here with commodities is really going to say, is a blast off or a bust about to happen? And we know what happens to Wile E. Coyote many times. So again, the Hussman Valuation Model is high. This ratio is testing support. Semiconductors are testing 25-year Fibonacci extension level. We have another huge support test, and emerging markets are testing 2007 highs. So thank you again for joining us for your Daily 5. Check us out for a large 40% discount by going to kimblechartingsolutions.com/StockCharts. Thank you, everyone. Take care.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.